Hello and welcome to AI Market News by LM. Before we begin, just a quick note. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion.
All right, welcome back. Today we're doing a deep dive, really trying to cut through some of the noise in the global financial markets.
Yeah, there's always so much going on.
Exactly. We've got a whole stack of resources here, and the idea is to navigate today's key movements, the indicators. Basically help us all understand the forces shaping things right now.
That's the plan. And our sources today cover quite a bit: economic calendars, market sentiment tools, specific currency pair info, equity performance, all that good stuff. Our mission, really, is to pull out the most crucial insights from all this data, give everyone a clearer picture without getting lost in the weeds. Yeah, and that's what I find so fascinating, how you can see the connections, right, between, say, a central bank decision over here and how a specific stock trades over there, or how currencies shift globally. It's like tracing these invisible threads.
It really is all interconnected.
Okay, so let's unpack this. Where should we start? Maybe the big picture.
Sounds good. The macro environment, central banks, that usually sets the stage.
Right, because there's always that buzz, isn't there, about what the Fed or the ECB might do next, and it feels particularly loud at the moment.
It does, and looking at the central bank rates from our prepared resources, the differences are quite stark.
Okay.
Well, the Federal Reserve, the Fed, they're holding at 4.50%. Their next meeting is September 17th, 2025.
Okay, 4.50.
Then you've got the European Central Bank, the ECB. They're at 2.15%, meeting a bit sooner, September 11th.
2.15. Wow, that's quite a gap already.
It is. And then the Bank of Japan, the BOJ, is way down at 0.5%. They're meeting September 19th.
0.5.
Yeah. So you see this huge spread, right?
Yeah.
Especially between the Fed and the others.
Definitely.
And that rate differential, it's not just a number. It really acts like a magnet for global capital.
Yeah.
Higher rates tend to make a currency, like the dollar in this case, more attractive. Affects everything.
Right, like exchange rates, import costs, the whole 9 yards.
Exactly. Now, to get a sense of what the market thinks the Fed will do next, there's a tool we can look at.
Okay.
It's the CME FedWatch tool. It basically tracks the implied probability of rate changes from the Fed's policy meetings, the FOMC meetings.
How does it do that?
It uses data from the 30-day Fed funds futures prices. So it's kind of like looking at the collective bets the market is placing. It gives us this forward-looking view of expectations.
Interesting. So it's like a window into market anticipation, not just reaction.
Precisely.
Okay, so we have the FedWatch tool showing expectations, but then we see some pretty dramatic headlines hitting the news feeds. Stuff like, Trump fires Fed Governor Cook over alleged mortgage fraud, or Trump moves to oust Fed's Cook, escalating unprecedented fight. That sounds intense.
It does. It introduces a layer of political uncertainty, for sure.
At the same time, you see other things like U.S. dollar, Powell's dovish tone keeps greenback vulnerable, or Powell hinting that rate cuts might be coming soon.
Right.
So how do we square this like political pressure versus potentially dovish signals from the Fed chair himself? How seriously should we take reports of an unprecedented fight?
That's a really key question, because the market really values the Fed's independence, or at least the perception of it.
Right, stability is key.
Exactly. So headlines about political interference, like with Governor Cook, they definitely inject uncertainty. Investors don't like that. And it can cause volatility as people try to figure out the political risk.
Makes sense.
And then you overlay Powell's dovish comments hinting at rate cuts. That directly hits market sentiment. Well, if the market starts believing rate cuts are coming, that generally makes the U.S. dollar less attractive from a yield perspective, right? So the dollar might weaken.
Okay.
And that weakness then ripples out. It can boost certain equity sectors that, like cheaper borrowing costs, but maybe worry others if it signals underlying economic weakness.
Gotcha. So it's this mix of political drama and the Fed's own signaling, creating, well, a pretty complex picture for rate expectations.
It really is. The uncertainty itself becomes a factor the market has to price in.
A clear example of how macro news hits different areas. Okay, so if central banks are the conductors, maybe stocks are where we see the raw investor emotion. Let's shift to U.S. equities.
Good transition. And looking at the major U.S. indices from the info we have, the picture is, well, generally cautious.
Yeah, what are the numbers showing?
The S&P 500 was recently at 6,439.32. That's down about 0.43%.
Okay.
The NASDAQ, 21,449.29, down a bit less, 0.22%. And the Dow Jones Industrials at 45,282.47, down 0.77%.
So declines across the board.
Yeah, and the futures are also suggesting some small dips might continue. So that cautious mood seems to be lingering a bit.
Right. So how do we gauge that mood, that collective emotion?
Well, one really useful tool for that is the CNN Fear and Greed Index.
Ah, yeah, I've seen that one. What's the core idea behind it?
The basic premise is pretty simple. Too much fear in the market can push prices down, maybe creating opportunities. Too much greed can inflate prices unsustainably high.
Okay, makes intuitive sense. But how does it measure that? It's not just guesswork, right?
Oh, definitely not. It's actually quite sophisticated. It combines 7 different indicators into one score, from 0, which is extreme fear, to 100, extreme greed.
7 indicators, like what?
Well, it looks at stuff like market momentum, comparing the S&P 500 to its 125-day average. Above is greed, below signals fear.
Okay.
Stock price strength. So the number of stocks hitting 52-week highs versus lows. More highs suggest greed.
Right.
Stock price breadth that uses something called the McClellan Volume Summation Index. Basically, declining volume can signal fear.
Gotcha. Volume matters.
Big time. Then there's put and call options. It looks at the ratio of puts, bets prices will fall, to calls, bets prices will rise. A rising ratio, especially above 1, signals fear.
Hedging behavior.
Exactly. Then market volatility, using the VIX index. A rising VIX signals more fear.
The fear gauge itself.
That's the one. Number 6 is safe haven demand, comparing returns between stocks and bonds. If bonds are doing much better, it signals a flight to safety, so fear.
Okay.
And finally, junk bond demand. It looks at the yield spread between riskier junk bonds and safer investment-grade bonds. A smaller spread means investors are willing to take risks, greed. A wider spread means more caution or fear.
Wow, okay, so it pulls from lots of different market aspects: options, bonds, volatility, breadth.
Precisely. Give it a much broader picture of sentiment than just looking at, say, the S&P 500's daily change.
And we see this emotion in specific stocks too, right?
Yeah.
Sometimes wildly.
Oh, absolutely. Based on our sources, look at INHD. It was a top gainer, up an incredible 262.60% with unusual volume. That's some serious excitement or maybe speculation focus there.
Yikes. And on the other end,
EPAX was a top loser, down almost 60%. So you see these extreme moves reflecting very strong feelings, positive or negative, about specific companies.
and the broader market, does the data show if it's mostly gainers or losers overall?
Yeah, the NVIS data gives us that breadth picture. It showed about 67% of stocks declining recently versus only about 30% advancing.
So more losers than winners.
Considerably more. And maybe more telling, over 40% of stocks were trading below their 50-day moving average.
Which suggests
Weakness is fairly widespread, not just isolated pockets. It paints that picture of general caution or maybe even fear across many sectors.
And this all feeds back into that fear and greed index.
Exactly. When you see widespread declines and lots of stocks below key averages, that pushes the fear indicators within the index, like stock price strength and breadth lower.
Got it.
A huge jump in one stock like INHD might show localized greed. But the overall index reading depends on how broad these trends are. It connects the micro, individual stock moves to that macro sentiment reading.
Fascinating connection. Okay, so just as stocks show investor feelings, currencies tell a big story too, right? About global economic flows and confidence.
Absolutely. Currencies reflect those large-scale shifts in capital and expectations.
So let's talk currencies. What are the key pairs telling us now?
Well, looking at the data, the year USD saw a small lift, up about 0.24% to trade around 1.1645.
Okay, euro slightly stronger against the dollar.
Right. And meanwhile, the USD-GPY pair was down slightly, about 0.14%, putting it at 147.57. So the dollar also weakened a bit against the yen.
Interesting. Dollar down against both the euro and the yen. Does that connect back to what we discussed earlier?
It seems to. There's analysis suggesting the USD is poised to break out of a tight range if US data weakens further.
Ah, okay.
And that fits right in with the Powell's dovish tone keeps greenback vulnerable idea. If the Fed sounds less aggressive, or if US economic data comes in soft,
Then the dollar becomes less attractive.
exactly, less yield appeal, potentially slower growth signals, it could push the euro higher against the dollar, breaking it out of that range. It really shows how Fed expectations and data directly impact these major pairs.
It really is all linked. Now, you mentioned tools earlier. Are there specific tools for currencies that give us clues from traders themselves?
Yeah, there are some really neat ones. OANDA, for example, provides an order book and a currency strength chart.
Order book, what does that show us?
It's pretty neat. It visualizes where OANDA's clients have placed their orders and where their current positions are.
Well, you see pending orders.
Right, the unexecuted buy-ins, the limit orders and stop orders, and also the existing open, long, and short positions.
How does that help?
Well, areas with lots of pending orders can act as potential support or resistance levels, places where price might stall or reverse. And you can also see where lots of traders might be struggling holding losing positions. If those positions hit their stop losses, it can actually accelerate a price move. It gives you a sense of market positioning and potential pain points.
That's clever. A peek into the collective mindset, almost. And the strength chart.
That one's simpler, but also useful. It just tracks the real-time strength or weakness of 8 major currencies against each other.
Ah, so you can see at a glance, like, is the yen strong today? Is the Swiss franc weak?
Exactly. It gives a quick visual snapshot of which currencies have momentum globally beyond just looking at one pair like Euro USD.
Cool. Okay, so we've looked at today's picture, the sentiment, the currencies, but what's coming up? What should we keep an eye on right now? The economic calendar, I guess.
Definitely. The economic calendar is crucial for seeing potential volatility triggers just around the corner.
And investing.com has a good one, right? What's on deck for today, August 26th?
Yeah, looking at investing.com's calendar for today, there are several important U.S. releases. At 8:30 a.m., we've got the durable goods orders for July, both the core number and the headline number.
Right, manufacturing and business spending indicators.
Key stuff. Then at 10:00 a.m., 2 more. The CB Consumer Confidence reading for August.
Always a big one for spending forecasts.
And the Richmond Manufacturing Index, also for August.
Okay, so a decent chunk of U.S. data. Anything else?
Yes, also important are scheduled speeches. We've got FOMC member Barkin speaking, plus officials from the Bank of England MPC member Mann, and the Bank of Canada Governor Mackel.
And speeches can sometimes move markets just as much as data, can't they?
Absolutely, sometimes more. A slight change in tone or forward guidance from a central banker can really shift expectations quickly.
And the great thing about these online calendars, like investing.com's, is you can filter them, right?
Right.
By country importance.
Totally. You can really zero in on the events that matter most for whatever market you're watching. It's incredibly useful for planning.
So it's about understanding how these upcoming releases might hit the markets we've been discussing.
Precisely. Think about it. If durable goods comes in surprisingly strong or weak, what does that imply for Fed policy?
Right. Could it change those Fed watch probabilities we talked about?
Could do. And that would likely impact Euro USD, USD JPY, maybe equity sentiment too. Same with consumer confidence. It affects the outlook for growth. These events are the catalysts that can either reinforce the trends we're seeing or potentially turn them on their head.
It really loops back to everything we've discussed: central banks, sentiment, currencies.
It all connects.
Okay, wow. We've really covered a lot of ground here. From the signals in the fear and greed index showing us that market mood,
The caution we're seeing.
to the forward-looking clues from the ONDA order book, and of course the economic calendar, plus how central bank talk and even political headlines filter through. So wrapping this up, what's the main takeaway for us trying to navigate all this?
I think the biggest thing is realizing it's about connecting these diverse dots. You can't just look at one indicator in isolation.
Right.
But when you start layering them, the sentiment, the macro data, the upcoming events, the currency flows, you start to build a much more complete, much more informed picture. It helps us anticipate potential shifts, not just react after the fact.
Makes total sense, putting the pieces together.
Exactly.
So maybe a final thought for everyone watching. As we move forward, consider how these different levels, the micro stuff like specific stock pops and drops, and the macro themes like central bank policy and politics, how might they converge and diverge in the next few weeks?
Yeah, will they reinforce each other or pull in different directions?
And what surprises might be lurking in that economic calendar that could really shake things up and shift these trends we're seeing now? It's always evolving.
Always. Keeps it interesting.
It certainly does. Definitely keep exploring how these pieces fit together.
Okay, that's all the time we have for this deep dive. Thanks for watching. Don't forget to like and subscribe.